You didn't think you'd be getting turned on by a property video today, but today we're talking about taxes. Alright, so taxes are not the most sexy subject in the world, but actually I think they are, because a lot of taxes are optional. And don't get me wrong, all the haters out there, I am all good for paying tax. And by the way, every single quarter I have to pay six-figure sums in tax, multi-six-figure sums. I'm a big fan of it, HMRC. However, I think I am going to pay as much tax as the system deserves. I am not going to pay a penny more, and actually, you need to have an idea of property taxes all the way through the funnel and understand how you can legally mitigate them. This video is really just a basic overview of each, and if there's any of them that you want me to go in depth on and really geek out on, I'm all for it, all right? So if there is, first of all, subscribe, hit the notification bell, and let me know as I'm going through them if you want me to do deep dives on any of these sections. Now, the first one is stamp duty. Thank you, government. It's really good that you're adding another tax to contribute to society. Why stamp duty? Stamp duty is a land tax, so it's not technically to do with the property, it's to do with the land that it sits on. So when you buy a property, there's value created in that transition, right? And naturally, when there's any exchange of movement of money, the government wants their slice of it. So stamp duty is a tax on the purchase. Now, when you're an investor, you pay the same stamp duty as a residential purchase with a 3% surcharge. So it's really important to understand this, but sub 40k, you don't pay any stamp duty, including the 3% surcharge. There is nothing. Now that's why you'll find when you're in really cheap areas, often people will buy a property at $39,999 because they don't have to pay the 3% surcharge. Whereas at 40,000, just £1 more, they will pay $1,200 in stamp duty. Everything above that is 3%. So if you buy a residential property at 100,000, you don't pay any stamp duty. However, as an investor, you're meant to pay the 3% surcharge. Now, the thing is, actually, there's a lot of exemptions, and this is why you might want me to do some geeky videos. There's some that are like black and white exemptions. There's some that are a bit more grey area, but the black and white ones, for example, property traders exemptions, you've got the exemptions if it's uninhabitable, you've got probate exemptions, which is when somebody dies and unfortunately somebody inherits it. And what's another one? Multi-dwellings relief, you've got commercial relief, all of these different reliefs from stamp duty. Now, they are there as loopholes to take advantage of. And this is all public record if you know where to look. Now, an exemption doesn't always mean you go from, hey, I paid £30,000 in stamp duty and now I'm paying zero. However, you should always be looking if there's any stamp duty relief so that you're not needing to pay. Now, is it on every single property? No, it's incredibly rare. But if you understand the situation, there are situations where you might be able to mitigate and lower that stamp duty tax. Now, why would you really care about it? Because it's cash. Now, if you think about the whole concepts of property, it's based on leverage, right? So where you make 80% of your money in property is through capital appreciation. But the reason you make so much in that is because it's leveraged money. So if it's got 5% capital growth, for example, that's on the whole asset value, but you've only got 25% equity in there and the rest is debt. So 5% on 100 grand is 5 grand, but 5 grand on your 25 grand investment is a 20% return, right? Hopefully that makes sense. But when you're investing the tax, it's all cash. So if on that £100,000 purchase, I have to put £3,000 more in, my return on capital employed suddenly as a percentage is dropping day by day. Next is capital gains tax. Yay! So capital gains tax is a tax that we pay, if we want to, tax that we pay on the increase of value of an asset. So most people would think if you're holding it for longer than 12 months, it's a capital gain rather than an income tax, which I'll get to in a moment. What that means is each tax year, so April the 5th till April the 5th, you can get relief. So if I bought something for 100 and sold it for 120, I've made 20 grand profit in there, but the first 10,500 or whatever it is right now is tax free. Now, capital gains is only if you, number one, sell the asset for a profit, like a higher price, and number two, if you own it in your personal name. It's really important to understand that. You don't pay capital gains tax as a business. So if you own it in a limited company, that's another tax called corporation tax. Okay, so you pay a tax. Just tax from every fucking angle. It's great. It's really great. I love it. Love it. So the capital gain is only if you pay it. Now, the reason why I say that's optional is, in my opinion, why would you ever fucking sell an asset? Like, why? It makes no logical sense. In the long term, property ends up selling. I'm going to go into a little rant here. I promise it will be valuable to me at least, and hopefully some of you also get value. Now, let's go with your 100 grand property. And let's say it's now worth 200,000, just as an example. Now, if I sell that property for the 200,000, often it's not really going to sell for 200. And if I want a quick sell, let's say I need the money in the next few months, I might sell it for 190. Then I'm going to pay some agency fees. So let's say that's 2%. So now I'm not getting 180. I'm going to lose 3,600 on that. Then I'm going to have my legal fees and anything else. Let's call it, now we've got 5 grand worth of fees. So now I'm at 185,000. And then, of course, on that 85,000, I'm now going to pay some tax. Let's say I'm at the 18% tax on capital gains. Just for ease, allow me to do 20% just for ease. So I'm now going to pay £19,000 in tax. So I'm not getting 85 grand in my pocket, am I? I'm actually going to get 67 grand. Hopefully I worked that out right. But around 67k. Okay, not too shabby. But I've also now not got the fucking asset. And I've probably had to empty the property and not have a tenant in it, because then I want to open it up to more buyers. So now I've also been paying the council tax, more on that later, and the mortgage in the meantime. So probably just more money. Scenario number 2. I bought it 100 grand. It's now worth 200. I now refinance it. So I'm going to get a new mortgage at the new value. A RIC surveyor goes out and they go, hey, this is worth £200,000. Great. Give me a mortgage of 75%. They go, no worries. So you get 150 grand loan. 100 grand of it doesn't go to you. It has to pay off the 100 grand mortgage, the other mortgage, because there's going to be a new mortgage on it. And now you get 50 grand minus, let's say minus 5 grand just for the sake of this video. So now you've got 45 grand. Well, Jamie, the other one, I got 67. Yes, okay. So there's a 22 grand difference. Now you have to think to yourself, what are you going to do with that 45k? Is it enough? But here's the thing. You don't pay any tax on that 45 grand because it's debt. Okay, so yes, you're going to pay a bit more for that, but the rent will more than cover it, because if it's gone up in value, the rents have gone up, it should cover the debt on there if you've invested in the right area. And you've got the asset that's paying you on a monthly basis. And you've got £50,000 in equity there that is genuinely adding to your net worth, which you pay 0 point fuck all on the tax. I hope you can tell I'm passionate about this sort of thing, right? Do not sell your assets unless it is absolutely necessary, or it was a deliberate flip in the first place. So capital gains tax shouldn't really be a thing. I'm going to stop venting now. Income tax, another completely optional thing. Well, semi-optional. So income tax is from the rent if you own it in your personal name. So there's 2 ways of really paying the income tax here. Is if you own it in your personal name already, then what's going to happen is you are going to end up getting your income, you've got your job as well, and then whatever tax threshold you are, whether you're 20%, 40%, 45%, you are unfortunately going to pay that on the profit. Now, if you own it in your personal name, you've also got something called Section 24, which is the government really like working with us as individuals. Now, if you don't know what that is, basically the government decided in their absolute fucking idiocy that they decided that actually, by the way, if you own it in your personal name, you know, the mortgage that you're paying that's a completely legitimate business expense, it's not a legitimate business expense anymore. But if you have it in your limited company, no problem at all. Of course it's an expense there. How the fuck does that make any logical sense? But anyway, If you own it in your personal name, I'm not a tax advisor, but I can near guarantee if you are a 40% taxpayer especially, it ain't fucking good for you. You only get 20% relief. Not going into it. Again, let me know in the bottom if you want me to go in more detail. The other situation is owning it in your limited company. Now, you could legitimately say, well, yeah, but the problem is then, if you own it in your company and you keep it there, you are going to have corporation tax, which is a tax on the profits of the company. You're correct. You also be correct in saying, but if I also want that money as an individual, then what's going to happen then is I'm then going to pay, well, I won't pay corporation tax, but I'll have to pay it to myself and then I'll pay personal tax on it already. Or I pay corporation tax and then dividend tax as it comes through. Also correct. So you need to talk to a tax advisor. Look, you're listening to a YouTube video. I don't know your personal situation. Neither am I qualified as a financial tax advisor, okay? So this is just an opinion, but talks to a tax advisor. However, let's say, like me, I've actually got a business. Well, what can I do when I am running a property business? Well, I can have expenses. For example, this laptop is not me going to buy a laptop. This is a business expense. So if I go and buy a £2,000 laptop, that is a business expense. Let's say I am going to buy clothing. Well, there's certain things you need to do. That is a business expense. Let's say I go over to Spain to check out some property investments and I take my PA with me. That is a business expense. I think it was in Alan Sugar's book, he said, your life is an expense. Everything is an expense. Now, well, that sounds close to tax dodging, all right? However, this is some piece of advice. It's HMRC don't care what you put through the books. They care about why you put them through the books. Now, this was a tax advisor that said it, but again, it's just taken with a pinch of salt. Why am I putting it through the books? So for example, let's say I go and buy a laptop and I'm just using it as for gaming. Well, why did you buy that laptop? For gaming. Well, that's obviously not a legitimate expense. However, if I am going on there and it's like, I bought this laptop as a genuine business expense and I'm going to use it for business, that is a legitimate business expense, as with all of my team stuff. So the camera that is filming on, I'm not paying for that, the business is. And the bigger you get, naturally more logical it is for more expenses. So at my level, for example, if I have a nice car and it is a staff car and it's only used for business use and I've got a driver for that, then that is a legitimate business expense. The reason I'm saying that is, as eventually a tax strategy within business is, instead of needing to pay yourself to have your life, how much of your life is a genuine business expense that you just don't think about? How much of your home space do you use as an office legitimately? And I'm not saying this to dodge tax, but there's probably a lot in your life that is a legitimate business expense if you are building a property business. Now, the truth is, there are loads of taxes. The other ones that I could cover is inheritance tax. There's loads of ways to mitigate your inheritance tax, by the way. And again, if you want videos on that or any of them, please let me know. And in fact, if I do get another request, like a big request on it, maybe I can actually bring a tax specialist onto the channel with me to talk about these things. I do have a lot of knowledge, but again, I am not qualified on this. So please, I just want to reiterate, it is just my opinion. However, this opinion comes from personal experience and tax advisors that I have paid a lot of money, including KPMG, tens of thousands of pounds on this. So I'd like to think the knowledge is good. The truth is, if you're watching this video and you're wanting to build your portfolio and you want to make sure that you've got this team around you to make sure you're doing it, not only finding the best investment opportunities, but having the best tax structure involved, then put APG in the comments. Now, this isn't just random. This is if you want to build your boring vanilla buy-to-let portfolio and you want help to do it. That's what we actually specialize in Aspire Property Group. So put APG in the comments if you've got 50 grand or more, you want to build your portfolio and you want to book in a free one-to-one consultation session. We've opened up some spaces for that. You'll talk to one of my team where they'll help understand where you want to be in the next 3 to 5 years and how we can help you build that portfolio in the most tax efficient way in 2024. I hope you got value from that video. If you did, make sure to hit the subscribe subscribe and the notification bell, destroy the like button, and I'll see you in the next video.